Hey, welcome back to Just Figuring It Out. We've got a different kind of episode today. Ian, Alex, and I were not able to get together. So I was thinking rather than skipping a week and not being able to provide any kind of value, what we want to do is we actually ran a workshop this past Friday on if you run a 7-figure business and you end the year kind of wondering where does all the money go? That's exactly what we're breaking down in this workshop. And we're going to turn it into a podcast episode for you guys. You can understand, see behind the scenes of how we look at businesses that are doing, 7, 8 figures. A lot of times we get owners who are coming, I did record revenue numbers last year, but man, I feel like I don't know where any of the money went. I don't have anything left over. Maybe it was, struggling to pay myself. We even had people have to take out loans to be able to cover payroll. And so we're going to break down what are the causes of this? What are the symptoms that are the signs of this? And then how do we get to the root cause? So I hope that you enjoy this episode. We will be primarily listening to Alex breaking this down. It's a different episode, so there will be some back and forth, people talking, but hopefully you're excited for this one.
But we've had a lot of wild stuff happen lately for clients where the answer to the question of where did the money go was fairly surprising. And so we thought, this is a good time to just pull together a bunch of stories, sort of to be able to show what are the principles of as a business owner, how do I figure out where my money's going? How do I make sure that it's not leaking out the bucket somewhere or just like walking out the door without me noticing? And sometimes as business owners, we feel like I'm pushing so hard, I'm growing, I'm doing all these things, and it doesn't feel like the money's there to sort of back up all this work that I'm doing. So we're going to talk about that today. Y'all, can you see my screen? Yes,
Yep.
beautiful.
Got it.
Where did the money go? Maybe you made $3 million last year, but you have no clue where it went. We're going to figure that out together today. We'll do a quick intro to ourselves in a minute, but to kick this off, we're going to tell stories too, by the way, all from clients that we've had that will de-identify everything. But to start off with this, for example, we had an electrical contractor that signed the biggest job in the history of his company and best month they'd ever had in terms of new sales. And at the end of that same month, had to go take a $60,000 personal loan against an RV to be able to fund payroll. That's not the kind of business we want to find ourselves in or the situation we want to find ourselves in. So the question isn't, how do I make more? He made more. That wasn't the problem. The question is, where did the money go? And how do I make sure that I don't end up posed as a business owner when I grow this thing and then just feel like, man, I expected that growth would solve all of these problems. When in fact, as we'll see, growth often exposes problems that were laying under the surface. So here's how today works. We're going to talk real stories, real numbers. The names are changed, but the actual figures aren't. And I think as we go through this, you're going to leave with something to check in your own business tonight. We're going to see a number of different things that you might potentially want to check. I would highly recommend taking some notes as we go through things of like, hey, I need to kind of double check myself on this. And at the end, actually probably halfway through, I'm going to tell you what to do in case you want our help to guide you through this. But in the next 45 minutes, if we don't earn that right, then just ignore the offer. So real quick, what kind of business do you run? Will you just type it in the chat so that as we're giving examples and things today, or we're doing Q&A at the end here, I can know what you're running. We are CEO Finance Academy. Obviously, we run, we're just nerds, basically. We're just big nerds. That's our company. We do financial consulting and coaching, but I know that we've got a broad range of people and different things that they do here. Sweet HVAC, awesome. Great to have you here. I know that we've got a lot of people in the trades businesses. We've got lots of service-based businesses in our realm, electrical, civil construction, electrical vehicle charging. Whoa, Chris, you're doing a bunch of cool stuff. Wow. Very cool. All right. Well, hopefully some of this hopefully doesn't hit too close to home for some of you as we talk about these stories. But if it does, know that you're not alone as a business owner and trying to figure this stuff out. So as we get started here, I want you to look at these two different numbers and just like feel it for a minute. This is from the same company, same month. The P&L said $180,000 of net income on paper. On paper, that was correct. What did the bank say? $9,000 in the checking account. That was also correct. Both of those numbers can be true at the same time, and nobody's necessarily lying to you, unless maybe they are. We'll see that as an example in a little bit. But how could this be? And why does it have to be so stinking confusing? So this is ultimately a visibility problem in a business. It's not an intelligence. It's not having the right data. It's being able to see it and know what's actually underneath the surface. So your bookkeeper, we all probably have bookkeepers and our tax people. That's great. Our bookkeeper records what happened, and your accountant files what happened with the government. But neither one of them ultimately has the job of asking whether what got recorded is actually true. And maybe even more importantly, what it means for you, the so what of all the numbers. And that's ultimately not a knock on them. They're doing their job, right? They're doing the job that you hired them for, except as business owners, we're just here tooting along in business thinking like, hey, I just hired the person and they're going to do their job. And we're maybe not quite sure what their job actually is, or we expect them to have a different role than they're expecting to have. And so sometimes in companies, especially where you're in the kind of 3 to 7 or $8 million range, you might have a great finance person or bookkeeper in your team internally. Maybe you're outsourcing it, but you're expecting that the person who is there recording the books is also helping you to interpret accurately what they mean and therefore what you should be doing. And those are two very different things as we'll look at today. So, what came in, what's still owed to you, and who's late? Some of that might not be something that they're going to be telling you. What each part of the business actually made, this is very rare for a company to come in, especially if you're, on the smaller side, maybe and I say smaller, this is plenty big business, $3 to $5 million, or maybe less. You often don't have it broken out clearly. What's actually making me money by income stream? This is one of the first things we do when we sit down with a company is figure out what are your different income streams? How much are you making from them? And how much is each one costing you? And then, for example, what's safe to pay yourself this month? I don't know, have any of you ever had a conversation with your bookkeeper about what you should pay yourself this month as the owner? Probably not. Imagine how that conversation would go too if you did. Might be a little awkward. Will, were you about to say something, man?
No, I was just going to say I've never once had that conversation with I think maybe early on I asked, and I got laughed like, not my decision to make.
Well, I remember even talking to our tax guy the first time we were filing. I was like, "Hey, man, so are we like paying ourselves the right amount?" And he was like, "Well, I don't know. It depends on lots of things." And we didn't really get a straight answer after that. Okay, what are those things? And in my business, what does it depend on? And oh, that's right. I'm only paying you to file taxes. Okay, makes sense. And then the next one, ooh, my slide cut off here. That's cool. But the next one, like, what does the next 6 months look like? If you were to go ask right now your tax accountant or your bookkeeper, maybe you even have a controller, maybe you have a CFO in your business or a fractional CFO. How confident do you feel about what the next 6 months might look like in your business? So, why are we the ones talking about this? Well, we've coached 225 businesses. I think we're past that now. Will we got to see. I'll bet we passed the 300 mark, or if not, we're really sticking close. 40
Yeah,
plus industry. What's that?
well over 350 actually. I
Dude,
meant to
I
update.
gotta update my
Yeah.
internal data then. But we worked with a whole bunch of people, a ton of different industries, ranging from electrical contractors to brick and mortar healthcare providers to Amazon businesses to solar businesses. You name it, we probably worked with it to financial services providers, bookkeepers themselves. But
Ankle
more important,
monitor companies.
what was that?
Ankle monitor companies.
Ankle monitor companies for felons who need ankle monitoring. There's some wild stuff. Dog trainers.
A
I
zoo?
love what's that, Ian?
A zoo?
That's right. We've had a zoo. Yeah. We've had zoos. We've had franchises, large and small, McDonald's, lots of different corn dog companies, all the things. We worked with a bunch. More importantly than any of that, though, we were actually business owners trying to figure this out ourselves before we went into the finance nerd realm. Will, Ian, and I, as owners of the company, we've all been healthcare providers. Ian actually owned his own brick and mortar healthcare practice. Will and I we ran a marketing agency before we kind of figured out this whole like, hey, I need to be able to understand money if I'm going to actually keep it at the end of the day. And we figured it out in our own businesses first and started seeing that the people that we were working with and as we were consulting with clients, they like had trouble figuring out money themselves. And they felt like finance was maybe their weakest point in business when they're really good at running the rest of it. Maybe they're great at marketing, they're great at running the jobs, but they just felt like on bidding a job, I'm not quite clear on figuring out how much I should save for taxes. I'm not quite sure. I don't know if I can grow and how to do it profitably or hire or what to pay myself. And so everything that we've done first happened because we went through it ourselves as business owners. And now that we've helped hundreds of companies, we got some stories, y'all. And so the stories that we chose for today will back up all the principles that we go through, but all of these happened within the last 90 or so days. So it's all pretty fresh stuff. So here's the thing nobody told you, and maybe you've been feeling it, but it's never been called out directly. Your profit and loss statement was not built for you. It was built for the IRS. If it was built for you, it would make a lot more sense for you as a business owner. But ultimately, the profit and loss statement and really all your financial documents were built to tell the IRS how much you earned so they can what? Put it in the chat. Why does the IRS want to know how much you earned? They're not sitting here thinking, oh, we want to put you on the Inc. 5000 list. They're not sitting here thinking, man, we want to honor you with Business Owner of the Year award. They want to get their money. Thank you, Chris. Yep. They want to get taxed, right? But it was never built. And so here's the problem. The government's like, all right, here's how we want to demand that you tell us what you earned. And then we as business owners just sort of say, all right, well, I'm going to use those documents since I have them to go figure out what's going on in my business. Except that it's kind of written A, in a foreign language, and B, it is not set up to give you insight as to where you're actually at and where you're going as a business owner. And so with that core misalignment, we end up with a lot of frustration around what our numbers might say, pending them actually being correct in the first place versus what the reality maybe looks and feels like. So in plain English, we've got your profit and loss statement, which tells us here's what you sold minus the cost to sell it over some stretch of time. That's kind of the movie. And we know that there's different ways of looking at that movie, right? Like it can be a documentary where it's like, hey, this is exactly what happened when it happened, kind of like a cash basis P&L. And then we've got your, I don't know what the other one would be. I should come up with a better analogy for this. We got documentary and we've got, what's a good like cruel, Ian, I need your dad jokes here. What's a good accrual basis P&L?
Well, depending on how you put it, it could either be a utopian or dystopian post-apocalyptic movie. Maybe. I don't know.
I love it. Zombie movie.
Yeah.
Okay. Yeah.
It depends on your perspective of how you're allocate or how you're framing it.
Yeah.
Well,
Ted and I, Ted's one of our CFOs that works with clients. He and I were on a call the other day with a client and we were talking about their profit and loss statement and it was accrual and it just didn't line up at all with cash, which is how it goes. And just like, yeah, well, this isn't super useful for making cash decisions then right now based on things. Anyway, that's what your profit and loss statement does. Your balance sheet is going to show you what you own versus what you owe right now. It's the photograph. It's a snapshot in time. And then there's distributions, for example. We're going to use a bunch of other terms, but to define a few things, this is money that you're taking out for yourself that's not an expense. And it doesn't reduce your profit on your profit and loss statement, but it reduces your bank account, the cash in there. So just a quick snapshot of like, hey, you can see how even just in this one item, the distribution thing, that isn't really built for business owners, right? Like the how they have built the structure of this just does not line up with making it simple for business owners. And so it can create all sorts of confusion that lead to the problems that we're about to see in the stories that we're going to hear today. So for example, things that never appear on your profit and loss statement, those owner distributions usually don't. It's paying yourself. If you're paying W-2 salary, it can. But here's the funny thing. We got a client right now that's like, yeah, I want to pay myself a bunch more. So I'm just going to pay myself a bunch more W-2. And I'm never going to take distributions because I'm not even sure if my business is going to afford it, but I'll just pay a bunch more in W-2. Guess what? He also pays a lot more in taxes. So unless you really love paying taxes, might be something you want to understand better. But things like paying down your debt principal, that doesn't show up on your profit and loss statement. It'll be hidden later when you get to depreciation, but it's not coming out on a big line item. Alex paid down $1,000 of his old debt this month. Things like paying personal income taxes, for example. Maybe you even paid out of the business, but the tax savings that you need for yourself, often that's not coming out on the P&L. And then when you buy equipment, again, it's not usually showing up right in that month as an expense. And so all four of these are balance sheet things that aren't going to show up on the P&L. And again, it creates this confusion. So this is why you can have $180,000 net profit month, but maybe only $9,000 in the bank. There's timing issues, and there's actually what appears on your P&L or not. So as we go through these stories today, we're going to talk about how money leaves through 4 different doors, but your profit and loss statement kind of has one window. So you got your revenue comes in, you've got your P&L that shows you a little bit of it, but it's not telling the full story because there's these other doors where money's leaking out. And not only these doors are potential places where your money could be leaving, but there could be, maybe this is a log cabin of a business and there's some gaps between the logs where money's leaking out that it really shouldn't be or that you don't notice it is. So 4 doors, 4 principles that we're going to be talking through today. Principle number 1 is that a system is not a control. We'll see what this means. In other words, you might feel like, yeah, I've got great systems in place, but do you have good controls in place? Somebody has to be watching the system and making sure that the system A is working, keeps working, and hasn't broken along the way. Principle number 2, the job isn't done when the work's done. It's done when the money lands. We'll see that in a couple painful ways. Number 3, you can't price what you've never actually measured. So if you feel like, yeah, I'm just bidding jobs and I'm bidding things, we got this great bidding template. I even have this thing where I automatically update my materials costs. I'm great. Maybe. But if you haven't actually measured it after the fact and you're feeling like, man, I'm not nearly as profitable as what I'm putting out on my bids, why? Well, we're going to look at that today. And finally, profit without a destination gets absorbed. In other words, profit needs a job, or else it's like the sneaky teenager that like just sort of walks out the back at 2:00. Like, no, come back. I don't have those yet, so I'm hoping mine aren't sneaky teenagers when I have. We're knocking on the door. We got a 12-year-old. We're so close. So let's talk some stories here today and figure out how do we avoid some of these things in your own business. So we got a demolition contractor that bought 2 pieces of heavy equipment last year, $80,000 each. It was a good year. They were excited about it, but they wondered why the tax bill was maybe feeling a little bit heavier than they were hoping. Guess what? Just buying the equipment does not automatically mean you get the tax write-off. There's another step in between. So what never happened? Well, the balance sheet never got updated with the $160,000 of assets that got purchased. And because bonus depreciation could have allowed them to take a large chunk, potentially even all of that as immediate cost in that year, they had lost out on potentially $160,000 of depreciation expense when they went to file their taxes. And because of that, then there was this huge tax write-off they didn't have. And on top of that, they weren't booking the interest expense on their profit and loss statement. Double whammy. And so now think about how small of a mistake that was roughly to like, oh yeah, I didn't tell my bookkeeper that I bought this equipment. Or like they looked at my account when I spent $50,000 to buy this thing and, got a loan for the rest or something. And they didn't ask me where all that cash went. To me, it boggles my mind that this could happen. It's like, bookkeeper, how do you miss $20,000 walking out the door? What do you just leave that as ask my accountant or something? Like, what are we doing here? But whether it's messy books, whether it's someone who has too much stuff going on, or there's a lack of communication between owner and person putting this on the books, this happens all the time. They had another client that had, I think it was close to a dozen vehicles that they had purchased over the course of about 10 years. Almost none of them were on the balance sheet. Let that sink in for a minute. This was hundreds of thousands of dollars of assets that were never listed. Therefore, depreciation was never taken on them. And so again, because the profit and loss statement is what we give to the IRS to report taxes, it's for them, not for us. That money just sat there not being taken as an expense, and gave an arbitrarily inflated look at how the business was doing, made it look better than it actually was. And they didn't get the tax write-offs or the interest write-offs. Not a fun place to be. And it's a really simple thing to fix. That's the good news. The core underlying problem, though, isn't just, hey, your bookkeeper needs to get better. Yes, maybe. But the core underlying thing is, as business owners, we're ultimately the ones responsible for what's happening in our business. And we're ultimately responsible for, like, we're signing on the line as well that, hey, these taxes are correct. And so it's on us not to really fully have to go learn tax law, but to level up our understanding of, all right, what are the basics of what I really need to understand as a business owner operating a 7-figure business? Because now there are implications for my ignorance if I stay in it. And that's ultimately what happened here. And so before you say, well, wait a minute, how do you miss a bulldozer? I want you to go check that every piece of equipment that you own is listed on your balance sheet along with the loan attached to it. And I would imagine that a real percentage of this room is going to find something. How do I know that? Because most people who come in and work with us have something like that that's missing on their balance sheet. Or you might go look at your balance sheet and say, hey, look, there's my liability. It's right there. It shows the loan, except it's a negative amount. It shouldn't be a negative amount. And so maybe it means that, yeah, my bookkeeper has been showing that a loan has been getting paid off, but we never put the initial loan balance in there. right? And guess what happens when you go to get funding? We're dealing with this right now with the client, literally this week. They have negative amounts on their liabilities. And the bank says, that's weird. You can't have negative amounts on your liabilities. What else is wrong about your books? Therefore, they can't get the loan until they get this thing fixed. And so it has all sorts of implications, not just for tax purposes, but for lending and ultimately for being able to make great decisions about where you're really at and where you're going in your business. Ted, I'm going to call you out for a minute. Are you willing to unmute? Ted's one of our CFOs. How frequent is it for you, Ted? Like, what percentage of people would you say have some relatively serious issues on their balance sheet or maybe their P&L as you look at clients coming in the door? Like, what percentage would you say have something that's like, oof, that's pretty wrong?
100%.
Ted is more bold than me. I like that.
It's a combination. Often the balance sheet has errors, whether they're entry errors, mistakes, imbalances, GL accounts that should exist that don't, or ones that are misplaced. It's very common to see that.
Yeah.
On the income statement side, same issue, improper allocation of expenses in the wrong categories. And as you mentioned, oftentimes if something is missing from the balance sheet, then that's going to affect the income statement as well. And you miss out on opportunities for tax savings and never even know it.
Yep. Man, and
It's very common, but most business owners, that's not their expertise. And so it gets overlooked. And they're relying on others to give them that guidance, and they're not getting it a lot of the time.
well, they're maybe relying on someone who doesn't know that's their job, right? Like they don't recognize or realize that that's what they're being hired for, or they might not even have the skill set for it, or they might just have so much on their plate, frankly, whether it's an outsourced bookkeeper and you get, a tiny percentage of their time each month, or they're an in-house person, but they're also doing accounts payable and accounts receivable and payroll and office stuff and right, like all the things. And so sometimes we have to step back and see the forest through the trees, so to speak. And it's hard for that person who's sitting in there all day and feels like they're behind on something. And to be able to say, ooh, you know what? I was looking at it and I have negative bank balances in two of our accounts for some reason, right? It's like, I'll get to it, but it just keeps going. Or this is one of the most common things. They inherit the mess from someone else, where back years ago, there was something that was done wrong initially and just kind of never got fixed. And Will, you bring up a great point with this. If you ever want to go sell your business, guess what the best way is to like have a buyer say, actually, I want a $250,000 deduction on the price. It's to hand them messy books. We had someone I was on a call with last month that got a steal of a deal on a business because they had crappy books and they couldn't support the actual income. And so he got to come in and scoop up a deal because the owner was just sick of the business, hadn't prepared things well, hadn't really taken responsibility for it. And guess what? Didn't get paid because of that. And so this is a costly thing. If you're thinking about selling the business, I really recommend, really recommend, if in the next 5 years you're thinking about selling or moving towards that, get started on this now. It's so much easier than when you go to sell. And we have someone just this week. Ian sent us a message just this week. Hey, so-and-so just got an offer on the business. It was like, they weren't looking to sell. I had no clue that she was looking to sell right away. And guess what? The right opportunity came in. And don't know if it's going to happen or not. But because everything was buttoned up and looked nice in the financials, she was ready to have that conversation confidently and not have to scramble and go, oh, crap. Because when the opportunity comes and the right buyer walks in, you want to be prepared for it. And you'll get a much higher multiple if you have clean, defensible numbers. And 1,000% you want to get on top of this if selling your business is intended to be part of your retirement fund. Totally. Yeah. Like if that is the retirement fund, then let's work on this now. It's a deposit into your retirement account. Okay. Enough on that. Let's talk about this one. This one is so wild to me. So food manufacturer. Okay. Really cool. Great business owner. Just love her to death. Came in saying, it all just feels so tight. Like I'm showing some profit on paper, but it feels rough. So on paper, she should have been profitable. When we looked at the numbers, it was like, yeah, like you're doing all right. I get that it's tight, but you're profitable. But she could just not understand why it felt so tight. And this is a business that had been around for a very long time. They had some big contracts. And when those big contracts dropped because of how the economy was doing, started feeling pretty tight very quickly. and realized that, hey, all along, I've never really had a good pulse on my financials. And now that things have shifted, oh crap, now I need to focus on it. So in this specific business, because she uses ingredients, food-based business, you would expect that those ingredients should be put on as an expense in the profit and loss statement. And again, I don't want to get super technical here. This is like, Phil, this is a little on the technical side, but they were putting those ingredients on the balance sheet as inventory. Guess how long ingredients last as inventory? Days, right? Like we're not
Except for my
automotive
mom in her
merchant.
pantry. Except for my mom in her pantry. It seems
Yeah.
to have an unlimited date.
Man, I mean, back in the day, my grandma had some things that maybe that inventory had been there for a couple of years or a decade or so. It's real, man. It was real. I learned what weevils were the hard way. But this 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 business had every single month. We started watching the balance sheet. And I was like, wait a second, tell me about this inventory line. And she was like, I don't know what inventory that would be. And then we looked at it over time. This is my favorite way to look at a balance sheet. Looked at it over time, over the past couple of years by month. And that inventory line was just getting bigger and bigger and bigger and bigger every month. And then we went over and we looked at the profit and loss statement. And for some reason, they were putting some ingredients from certain vendors that they were buying from on there. That was just fine. But then the bulk of it that was coming from a big wholesaler, that was all just going in straight to inventory. And so they were not telling the government, hey, we had $300,000 worth of expenses over a couple of years. And also, that means that the profit and loss statement was way over reporting profit. And so this is why she was feeling like it was so tight. By the way, one of the best signs that like, ooh, something is off and I need to address it ASAP is if you find yourself needing short-term crappy debt in your business. If you're like, shoot, I'm not making payroll. I need to go get a merchant cash advance, or I'm starting to look at my line of credit and my line of credit's getting more maxed out. And I've never had it maxed out before and it's staying there. Or, man, I haven't carried balances on my credit cards before and all of a sudden I'm carrying balances on my credit cards. Those are all signs that something under the surface needs to be looked at and addressed sooner rather than later. If we just let that keep going and if we think that the debt will get us by, we realize very quickly that it's just a Band-Aid solution. And so in this case, her book said that she made more than she did. And she already felt like it was like, oh, this is not that great. But because those purchases never ran through the P&L, her profit looked bigger than it was. So she was not making decisions based off real data. She paid tax on money that she never had because she didn't have the profit. And with that $300,000 write-off she was entitled to, it just sat there unclaimed 3 years. And so she could have had thousands, tens of thousands of dollars more in the bank from that than she had because it was just sitting there. So no fun. Don't do that. And it wasn't that her bookkeeper was careless. I mean, maybe a little bit. Her bookkeeper just probably saw a rule and this was an outsourced bookkeeper. And this is the problem. Sometimes with outsourced bookkeeping is they'll see a vendor or something. Oh, this is similar to this other vendor. Or it might even have a similar name to another vendor for another client that they have. And they'll just like, oh, cool. Yeah, that's probably inventory. Boom, they'll book it to inventory. And so the bookkeeper either didn't know to ask or the owner never sat down to look at the numbers, maybe with someone who could help them look at the numbers to say, hey, that's wrong. We need to fix it. And recording the numbers and understanding the numbers are two different jobs. So a bookkeeper does not necessarily mean interpreter of financial data. And only one of those jobs was getting done. Nobody is going to understand the numbers for you. This is kind of the big takeaway point here. It's on you as an owner to do that. And either you learn to read your financial statements or you have somebody else whose actual job it is to watch them, not just record them, watch them. These are two different skill sets. And I find that the people who are really good at bookkeeping don't tend to be the people who are also really good at the analysis side of things and especially the future focused side of things. They're really great at putting the puzzle together when you have the pieces. And it's like, all right, here's this piece goes here, this piece goes here. Like a good bookkeeper can do that, but they can't go build the 3D model of the thing. And this is just one of those doors that we talked about, one of the four. So this happened for another business where they were an S corp, and because of how all that works, they were showing 15,000 of profit for the year. But because they had taken a bunch of debt and stuff, they had a little bit more cash than that was floating around. The business owner actually ended up taking more than $15,000 of cash out of the business as distributions because of how the debt situation was working. And so because of that, the government treats that as additional taxable income. and taxed at ordinary income rates instead of S corp distribution rates. And guess what that means? Lots more in taxes. And so because she wasn't getting advising through this period, it should have been booked as a loan, and instead it was booked as sort of an over distribution. And guess what that means? A lot more in taxes. And you might be thinking, I have a great tax advisor. They file taxes for me. Yeah, but they're not stopping to ask these questions. And so because of that, 70,000, I think, is that Ian? Is that the amount that she's getting back? Is 70,000 or is, this is just wild. So she's getting back $70,000 that she paid in taxes, overpaid in taxes because of how this was done, amending these returns. And it actually took a fair bit of tax digging to find this out. But my goodness, expensive lessons. So 0 to 10, now that we've drilled in on the P&L so hard, 0 to 10, how clear is it that your profit and loss statement only shows you one door? Like it's only one slice of the pie. 10 is, Alex, I get it. You drilled it enough. Give me something else. 0 is, Alex, dude, I'm so lost. I have no clue what you're saying. And I feel like I understand my profit and loss statement even less. Will you just drop in the chat 0 to 10, how clear the P&L side of things is? Like, okay, yeah, there could be problems there and I need to be careful with it. That's one door. And because we're, okay, 7, hey, that was an honest answer, Chris. I appreciate that. And Ian always jokes with us. We can't choose a 7 out of 10 in our company internally when we choose things. So I appreciate that 7.5. All right. Door number 1, principle number 1. A system is not a control. Somebody has to be watching. So let's talk about this for a minute. Now that we've looked at that P&L, there's that little window thing there that shows us a little bit of the business, but not all of it. We'll get to these 4 underlying principles or 4 doors. A system is not a control. Somebody has to be watching. What does that mean? Well, let's take a roll-off dumpster company. The office manager who was in charge of payroll was sitting. This was the person who was in charge of making sure everyone got paid. Also paid themselves. Also started testing a little bit to see if anyone was watching. And when she paid herself a little bit extra, nobody said anything. And so payroll manager allowed payroll to start getting a little bit messy. There were a lot of things going out all at once. It started getting all choppy with when the payments were coming out. And because the business was in a relatively financial upheaval time, nobody really noticed. And it started off at $1,300 in a month, and then it was $3,000 in a month, and then it was $5,000, and then $7,000, and then the biggest month I think was $13,000 that was overpaid that should not have been. Why? Because nobody else was watching. All in all, I mean, this is incredibly painful to go through for the owner. I felt terrible as we were going through and literally categorizing, like, okay, there's the fraud there. Okay, there's the fraud there. There's the fraud there. We tallied it up. It was at least $73,000, and there was actually a fair bit more before that we couldn't say was conclusively fraud. It was overbilling, but $73,000 walked out the door in less than a year. Why? Not because they had poor systems. They had a good system for payroll. They had a good system for people punching time cards, but they didn't have controls. It wasn't that the bookkeeper was bad. In fact, this person was also doing a bunch of the bookkeeping. So ultra danger, right? Red flag, warning, Will Robinson. One person is doing the payroll. One person is paying themselves. And that same person is also doing the books and nobody else is watching. Danger, Will Robinson. The payroll system was working fine. It ran every 2 weeks and it never made a mistake for anyone else, right? He had one person who could both move money and check whether that money had moved. So the failure in one picture is like someone moves the money, someone records the money, and nobody else is watching. Versus somebody moves the money and someone else checks the money. It could have been a 5-minute, literal 5-minute check per week or per payroll period, and he would have saved himself $73,000. So was it the system at fault? Well, I guess technically you could call the check part of the system, but because he felt like he had a good system dialed in, but he didn't have the control on it, or in other words, someone else checking, the money just started walking out. So what do we do this week? I'm very serious about this, please. It was so painful to go through this with this owner. I felt terrible for them. They felt incredibly guilty. They were beating themselves up. And this happens especially in brick and mortar businesses where it's really easy to walk out the door with some cash. But please go pull 12 months of payroll and then look at the total number. And this is actually how we caught this fraud. We were going through and seeing like, gosh, payroll has sure been going up over the last year, but we haven't seen income going up to match it. What's going on? And then we started getting into like, oh, that's kind of weird. All of payroll is going up, but there's no breakdown by department. And they had multiple departments. And so as we started breaking it into department, that's where we noticed. But go pull 12 months of payroll and see, does every number that you see on there, does it make sense? Is there any gut level reaction? Okay. Number 2, list everyone who can start a payment. And I'm serious about this. Who has access to move money? Talking about payroll, talking about bills, credit cards, transfers. It's not just can they move money from the bank account for payroll. Like it could be that they're setting up a vendor account that's fraudulent. There's all sorts of things that we don't want to have to experience. So think about who actually has money to do that. And then is there one monthly moment where someone who can't move money, or might even be you, the owner, looks at the books or looks at the money to see where it went? And again, 5 minutes, literally a 5-minute check each payroll cycle would have stopped this for them and saved them $73,000. Okay. This was so painful. All right. Door number 2, principle number 2. So that first one is we got to have some controls. Okay. And seriously, go sit down and look at this. Okay. Screenshot that if you want and go do it tonight. It's a Friday night. Maybe you're not going to do it tonight. Maybe you'll do it today. There's still time on Friday. See, we left you time on Friday to go make this happen. So it's not a tonight thing. All right. Door number 2 or principle number 2. The job isn't done when the work is done. It's done when the money lands in your bank account. So story time, back to that contractor with the RV loan. Separate problem that we actually found out why they needed to go get an RV loan. This is a subcontractor, and the general contractor, we started noticing like, hey, they owe us some money. AR is getting kind of aging on here. And I like me some finely aged cheese, but I hate me some finely aged AR. And so we were looking at this AR and it was like, man, this is like stretching and stretching and stretching. What's going on here? And so we sent him a message like, hey, y'all, when are you going to pay us? And you know what they sent back? We don't owe you any money. In fact, you owe us money. Very shocked. And so they sent us a spreadsheet. And I'm not scared of no spreadsheet. If anyone knows me or has watched some of our content, you know that we build lots of spreadsheets. So I went through their spreadsheet line by line, started noticing some discrepancies. Like, hey, what's going on here? Well, their records didn't match, and those numbers were telling 2 very different stories. For example, because of the situation this subcontractor was in, the general contractor is paying what's called a joint check, where they say, hey, subcontractor, we're going to pay your materials supplier that you owe money to instead of paying you directly, and we're going to consider that payment to you. It's called a joint check. But some of those joint checks just never got cashed for whatever reason. And so nobody was really watching that. And so on the one side, the general contractor was like, yeah, we paid that. But on the other side, the vendors, the materials suppliers that this subcontractor was buying from were like, you owe us a ton of money. And so there's just this discrepancy of ultimately what was happening. And what we surfaced was $90,000 that right now we're going through and trying to recover with them that they actually owe. And it wasn't new revenue. They didn't need to make any new sales. They didn't need to hire any more people. They didn't need to pay any more overtime or any more payroll or any more COGS or any more anything. It was $90,000 for a job that was already done, already billed, finished, earned, not received. And so what's the principle here? Well, we'll see a pattern emerging as we look at a completely different kind of business that had almost the same problem. A dental practice doing about $2 million a year. How much? I want you to put in the chat. How much past due AR, accounts receivable, do you think they could pile up in 1 year without noticing? I want some guesses in the chat. This is not to shame the business owner. It happened because of how it happened. How much do you think? $2 million. How much past due AR? Ooh, we got some good guesses. 35, 200K. Ted heard the answer yesterday, so he can't guess. 110. Guys, this is so painful. 500. And if we're really aggressive, it was probably more like $700,000 of past due AR in 1 year. So what happened was the invoicing for all of this stuff lived in their practice software. And there was one sort of, I believe it was an outsourced team helping with that, but it wasn't syncing with QuickBooks. So there was never anyone really watching this. It just wasn't being addressed. And so what did that lead to? Bounced checks. The owner had to take a 6-figure loan from his family in order to cover the shortfall. And 60 to 70% of it was direct patients. It was not like, oh, insurance owes us money. It was patients, like individual humans. And so I asked the question as we were talking to, why didn't they just collect at time of service? And so this was ultimately a fundamental breakdown in the system. But you can see like, it's not just about growth. And this is the hard thing. is that this business looked like it was growing. Top line revenue, they're like, "Well, it's great," right? Accrual basis books looking good, buddy. Cash system, like non-existent system here, really, and therefore cash position horrendous. Growth doesn't create this problem. Growth exposes or reveals it. And this is the problem: as we grow, we think, "Oh, this is awesome. I'm growing." Guess what? We have to grow too. We can't just stay who we were as business owners at $500,000 a year in revenue and expect to have the same level of success or outcomes scaled when we're at $5 million a year of revenue. Ask me how I know, because I'm going through it. Okay. We've gone through it as well. And so when you're solo, you can kind of eat it yourself and maybe not pay yourself, right? You can get to it, you can take the hit. But then as you add team, guess what? They can't take the hit. And as things get more complicated, it requires a new level of systems, of understanding, and maybe of oversight. And so you might go check this week, pull an AR aging report from, if you have multiple systems, please check both, right? If it's in QuickBooks and it's in somewhere else, go check both if it lives outside of QuickBooks, okay? Anything past 60 days, does one named human own following up? And I'll just tell you, because sometimes this is the case for some business owners, Cindy in the front office might be the AR person, but Cindy might be really nice and kind and might like send people an email once a month, like, "Hey, just wanted to remind you about this." And that might not always work. We had a tire business come to us once, and they were nearing the end of the year and things were getting really tight. And they're like, "This is like terrible situation." So we talked about AR, and they had $200,000 of AR that was 60 days or more overdue. And I was like, "How did we get here, man?" And they said, "Oh, the person that used to do AR got moved up to a manager role, and now so and so in the front office is in charge of it." I was like, "Can we have that person who was maybe over it before and is a little bit more of a bulldog go like hunt this down and maybe even like give them a commission on anything that they go collect?" Guess how much of that 150K got collected over the next, or 200K got collected over the next 2 weeks? 150K. Because the bulldog got on there and said, "Hey guys, you owe us this money. We're coming to get it now." Right? Sometimes you as the owner might need to be the one to step in. But oftentimes you're just assuming that like growth is happening. I'm over here working with team. I'm over here working with clients or patients or whatever. And I forget about this part as a business owner and someone else is not watching. So if you have this in your business, ask, is there any one named human that follows up? And what is the process? If you're in a construction business, do you pre-lien your projects if you're able to? If someone actually owes you money, do you lien on them if that's the case, right? Do we need to get some legal things involved? Do you collect at time of service where you could? And for a lot of construction-based business owners, this is the thing that they could be doing, or they could be collecting a lot sooner if they were incentivizing people. When we built our house, the lumber was by far the biggest bill, by far. This was during COVID when all the prices were sky high. But guess what the lumber company did? They said, "Here's your invoice. If you pay us by the 9th of every month instead of the 30th of every month, we'll give you a 2% discount." Guess who got paid on the 9th of every month? Yep. They moved up the totem pole, right? Like they put themselves at the front of the line for getting paid because of that 2% discount. And you might be saying, "Oh, look, my margins can't handle a 2% discount." Well, guess what? You're probably already paying 15 or 20 or 25 for the debt that you're buying, your line of credit, your crappy factoring agreement, or whatever you have that's costing you way more than what 2% would cost you to get paid earlier. And you're ultimately playing bank instead of construction company, or bank instead of dentist, or bank instead of whatever. And that gets expensive fast. Okay, quick aside, then back to it. If this is something where you're like, "Dang, Alex, I'm A, either feeling guilty about myself, or B, feeling inspired that like I could level up. This is sweet." There's two ways that we can help you. And then we'll wrap up. We either have an academy version where you're sitting down with someone like Ted to go through step by step your own financials. And we have a sort of direct curriculum that you go through that's specific to your business, because you get to work with a human like Ted who can help guide you through it. Basically, like getting a mini MBA specific to your business. If you're feeling like, "I want to learn this myself and implement it myself," there's the academy. It ranges from 5,000 to 7,500, depending on what we're doing together. It's about a 2 to 3 month program. Or if you feel like this is great, but I actually want someone to do this for me and own the role, Then CFO services range from $3,500 to $6K a month, depending on complexity of business. Most fall at $3,500 unless they've got a bunch of entities. If that's something that you're like, well, that's cool, I would like to actually talk with someone to see if this is a fit for me. Will or Ian, if you've got a link, we can drop it in the chat and you can book a call with us. And it's not going to be some high pressure, like, no, why aren't you leveling up? It's just like, hey, let's go figure out where you're at. Kind of like stepping into the financial doctor's office. Be like, all right, I'm a little sheepish about this, but here's the situation. Guess what? We've seen it all. And because we come from a healthcare background, it's like we're used to sitting down with the patient that has to talk about some things that they might not want to talk about with their neighbor. And you're not alone. Lots of business owners in a scenario where they're like, I need to level up and I think I want some help. If that might be you, that's what we do. And hopefully you've seen that we take a very human-centered, maybe even slightly fun approach to finances. All right. Finally, door 3, principle 3. You can't price what you've never actually measured. What do you mean, Alex? Well, if you bid something and you're like, for example, this is the crappy drawing of a thing. What do you call that? The thing with ice that's underwater and the little bit. Damn, guys, words.
Glacier, iceberg.
The iceberg. Thank you. Titanic. So this is the iceberg thing, right? Where let's say you think about you're doing some hourly bidding for a job. Maybe you run an architecture firm or a construction company, roofing, whatever, and you're like, hey, I got to bid for my labor as well. But you're only bidding the hourly wage and forgetting things like, oh yeah, I got to factor in the payroll taxes and workers' comp, health insurance, and PTO and holidays and sick leave, and the personal truck that I give them and the phone that I give them and the tool allocation that I give them, right? All the things that actually go into a human providing a service. If you're only bidding off a small part of it, then guess what? You're going to say, yeah, Alex, we bid all of our jobs at 20% margin. And guess what margin you're going to have? 5%. And guess what that will cover? Some of your overhead and none of your debt and none of your owner distribution and none of your capital expenditures. And then guess what you'll need? Debt. And then that will not be fun. So don't do that. Don't be like this architecture firm that great humans, they did have a real system, but their labor number was still wrong. So they weren't factoring in benefits, insurance, payroll taxes into their hourly wages. And so as the business grew, that's a problem. Because if they just said, oh, last year we did $1 million and we had 100,000 of all those, and we just leave that as a static overhead number, which is what they were doing. They just weren't doing what we would call a fully burdened wage. And so they were bidding wages and then they would do the job and then they'd be like, why is this so much less profitable than we thought? Especially as they grow. And this is the problem with a growing business. It's a great problem to have. I hope that you are in a growing business, but we just can't use the same old thinking, the same old systems, the same old numbers that we used to be using for the bigger business. Or sometimes we'll have businesses that grow and then they're contracting and shrinking. And as they're contracting, they're thinking, yeah, it always used to work to be at 20% margin on all my jobs. But now that 20% margin on fewer jobs has to go cover all the old overhead that we've still got because we haven't shrunk the rest of the business. That can get expensive. So on roughly $925,000 of labor that they had, they were underbidding by $150,000 because they weren't factoring in all that other stuff. So that just never made it into the bid. Therefore, guess what? They had to eat it. And because they didn't look at their old jobs and see, were we winners or losers? And more importantly, why on those jobs? Then they had no way to say, oh, I'm going to go change it until we sat down and kind of forced the process. And if you don't have some way to track that cleanly, maybe you've got Buildertrend or something where it's like, hey, I've got all this in here, but I don't know how to use it or I don't go access it. Ask Ted and I how we know. We've been in some, not Buildertrend, but some other softwares over the last week, pulling out some numbers where it was like, yeah, I had no clue how to use that software to get these numbers, but it's sitting in there. Sometimes people don't even have that. And it's like, oof, I'm not measuring the things that I need to measure. Sweet. If we want to stay in business, let's go measure those things. Let's just put some stuff in place, right? We can learn new tricks, even if we feel like we're old dogs. Another example, we had a short-term rental management company that had a laundry and cleaning line. So they rent out Airbnbs and then they actually own the laundry service that comes in, but they were underpricing it and they were overstaffing it because they thought they had a certain amount of growth in their heads. And so they staffed up really big, but they didn't quite have that growth. And they had every tool they needed to see it. Ian can vouch, like they had the tools, man. They had lots of data. They just weren't looking at labor as a percentage of revenue on a regular basis. And so what that meant was for last year, they had a $156,000 loss without really knowing why. And then as we looked at that and said, hey, all right, let's start working this towards the goal of at least being a break-even service. How can, because that's not their bread and butter, right? It's an add-on service. But they had a $120,000 swing from last year to this year because they simply looked at how staffed are we versus how staffed do we need to be. And their staffing person just wasn't communicating things, wasn't looking at things, and wasn't thinking about it from a business owner's perspective. And this is a core point here. Most people in your business are not looking at the business like you do. They just don't. And we can't fault them for it. They don't own it, right? And so who does own it? You. And so as an owner, you and I are the ones responsible for making sure we're looking at things like an owner and maybe potentially helping our team look at things like an owner as well, at least giving them the lens that we're looking at it through so that they can see, oh, makes sense. And one of the easiest ways to do that is just like giving the team a scoreboard. Hey guys, this is where we need to hit. This is where we're currently at. Here's what we need to do. Let's go make a game plan and measure. So check this week. I want you to go take one employee. I want you to add up everything that you pay them in a year. I want you to compare that to the rate that you are actually estimating their labor for if you're using bidding software or something, or if you don't use bidding software and you're, let's say, a service-based business. Go look at their fully loaded benefits package, their 401k, their insurance, workers' comp, all that stuff, and go see how much are they actually costing me versus maybe what they're producing for me and see what does that look like. And then for this, it's easiest to just like pick one number and look at it maybe on a weekly basis. Maybe you're doing it monthly, but look at labor as a percentage of revenue is like such an easy one to just go look at. Okay. And if you're in a business where you have a high volume of things, maybe you do need to look at it weekly. It's a little bit lower volume or larger projects. You can look at it monthly, but keep up on that. There's something called Google this. If you are a contracting business or a construction business, especially, work in progress. Look that up. Your future self will thank you. That's all I'm saying. And if right now you're like, Alex, I know about work in progress. We got WIP reports. Cool. Are you using them? Are they accurate? Who's in charge of them? And what software is actually making sure that what's in there is accurate? And then do we use the WIP reports to like make adjustments to what we expect from a bidding standpoint, right? Okay. Finally, door 4, because I said that this would be 1 hour and I've got 3 minutes. All right, door 4, profit without a destination gets absorbed. So we had a commercial solar business. They were subcontracting out their labor. They were bidding by feel. They were throwing a percentage on top and hoping that they could just cover it. But some jobs were losing money outright. And year over year, after tightening their bids against real data, it was a $900,000 swing in net profit. So for a recent job, they did 1.2 million. It was a 1.2 million job. They added 40% to the bottom line because of that. Because rather than gut level, like, I think this is what we're bidding, or I think this is what we have to bid in order to win, right? If that's all you're doing and you're just going off of what you think your competitors are bidding, or you're bidding and then you're asking people where you're falling and you're like, well, I just want to fall cheaper so that I can win the job. Well, guess what? There's some people out there who are bidding on those jobs and winning them who will not be in business next year. Guarantee you. Because we see it. And so if you're going against, especially smaller contractors that are just getting started and don't know their margins and just like picked up a truck because they're like, I could do this myself, and they're underbidding you, guess what? They're going to find out the hard way is they either try to grow the thing that's not sustainable, or they just can't handle that. So know your numbers, bid accordingly, and just recognize, please, making money is not the same as keeping it. So changing our scoreboard internally from top line revenue numbers, I want to do 8 million a year. I want to do 9 million a year. I want to do 12 million a year. I want to do 15. That is not the scoreboard that actually matters as a business owner. It's a nice vanity number, but keeping it is so much more important. So instead of looking at top line revenue numbers, what if you said, I'm going to set profit numbers? I'm going to see how much profit do I want each year? And I set it based on that. And maybe we have to figure out, well, how much profit do I actually want or need? Maybe it's actually far less than I anticipated. And I don't need a $15 million a year business to get there. I could do it with a $4 million business. Interesting. We do this by looking at something that we call the wealth waterfall. And so profit waterfalls down And we reverse engineer our business to make sure that this waterfall can happen at the level we want it to. Because profit needs to go to cover taxes, right? It needs to cover reserves in the business. It needs to cover your debt payments. It needs to cover owner pay, like the baseline level of owner pay. And then maybe instead of your life here, you need to put like wealth. It's like, great. Now that we've taken care of all the needs, like what do you actually want it to do for you? And maybe the wealth thing is being able to take cash every month right now out of the business rather than saying like, yeah, someday I'll just sell and retire. That's fair too. Maybe that is your goal. Maybe it's like, I'm actually doing fine financially. I just want this to have enough legs that I can really sell it for the 10 million number or whatever it is for you. But this is the process that we actually go through on a not weekly, monthly basis with our clients. We sit down and we do this wealth waterfall together. We have this super nerdy tool that does it. And the cool thing is at the end of the month, we get to see this number, this reserves number. And that's my favorite thing to track as a business owner. We call it active reserves. How much is actually left in the business as my buffer after I factor in setting aside money that I'm going to need to pay for income taxes, after paying the debt that I need to, after paying me as an owner for my baseline needs and maybe even some extra for distribution, what's left over? And that active reserves number becomes one of our best measuring sticks or best KPIs for how the business is doing over time. And I know that for our owners that we work with, my number one thing is this is like my internal metric that I look at, like how are we doing on reserves over time? Like real actual reserves over time. It's so fun to watch it go. But you're the only person in your company on an unpredictable comp plan because of all this. So a big part of my goal for the people we work with is how can we smooth out that curve for you so that it's not like roller coaster of a business owner, right? Not fun because you're carrying all the risk. And so now let's look at sort of which door is really yours. You don't need to type this, but we've got door 1, 2, 3, and 4 that we talked about. And you just have to think about which one of these is really the one that I maybe need to focus on next. Do I need to focus on, am I letting one person send money and check how much money is going out? That whole like fraud door. Am I keeping invoicing in a system that doesn't talk to my books? Am I getting my accounts receivable, too long in the tooth? And now I need to have someone actually go chase it. Am I maybe bidding off incorrect data? We had one business owner who said, I keep up on my materials all the time in my bidding system. It's like we update it every month. But guess what? They bid the job. 6 months later, they do the job. And now the materials costs have gone up. They were bidding on today's prices, not 6 months from now when they're actually going to buy the materials for that prices. It's like, am I bidding off of reality or not? And then finally, number 4, are we taking money out whenever the account looks healthy with no plan for taxes or no plan for paying down my debt or no plan for my owner compensation? Like, which one of these do I really need to focus on? Cool. As a reminder, a system is not a control. Costs a business owner $73,000. The job isn't done till the money lands. $90,000 for one business owner, $700K for another. You can't price what you haven't measured. There's a $150,000 swing and a $120,000 swing for a couple owners. And profit without a destination just gets absorbed. That's why we like to have every dollar given a job every month. And we walk through this with our CFO clients. We're actually sitting down to do this. All right, let's sit down. Let's figure out how much we're saving for taxes this month. Not in April when you say, oh crap, I got to pull a bunch out. But this month, what do we set aside? Okay, how much do we need to set aside for CapEx? How much do we need to set aside for you, the owner? What can you afford to pay yourself this month? We sit down with our clients every month to do this. And when we do that, then our money has a job and it's much harder for that money to just walk out the door unnoticed. So the 60-minute workshop doesn't change what happens in your business, but understanding those 4 doors, building the habit of checking your numbers every month, that's ultimately what does. Some of you are going to pull your AR report tomorrow, probably not on a Saturday. Maybe that's the only time you can. Some won't. And that's not a character flaw. It's that no one's making sure the job's happening. It's like accountability. So the order kind of matters with all this. When we sit down with a client, the first thing we do is we're going to make sure that we get the books cleaned. We work with your bookkeeper to make sure that things happen. In some cases, people are like, oh, I want a better bookkeeping. Well, we can do that too occasionally, but usually we're sitting down to actually make sure that we are working with correct numbers first. Then we're getting the real costs. We're figuring out how much does this business actually cost you? Overhead, margins, debt, etc. And then we're building out the systems, including that waterfall where we decide what money gets to go where. We're building out our projections so that we can say, hey, in the future, in the next 6 months, what will things look like? Now that I've tightened up the shit and I know where I'm at today, now where am I going to be at 6 months from now, 12 months from now? And how does a decision today impact me 6 months down the road? Should I buy this piece of equipment? Should I make this higher? Can we afford to expand locations? What will that look like down the road? And instead of it being this gut feel, it's based on actual data. So from here, you can either on your own go check those 4 doors, like actually do something with this information that we talked about today. We'll send out this recording so you can have it. Or if you're like, I want to accelerate this, I want to make sure that I do it right, and I don't want to promise myself that I'll do something and then not follow through on it, then we could do it with you where we actually sit down either together in our Done With You Academy, or we'll actually take on the bulk of the onus on that one to say, great, let's own it and we'll be your fractional CFO. And that's it, y'all. Next step would be if you want to book a call. We usually tend to work with people who are in the 500K plus range. We've got some options for lower price things for those who are below that, but book a call. We're not going to hard pitch you. We'll see where you're at in the business, point you towards where you need to go. And that's it. Bam. All right. That was all for today. I'm curious, like what hit as we land? I know it's still 6 minutes of your day that I didn't promise you I would. Any biggest takeaway? Like what was the thing that like, I need to go do this now? You just drop in the chat if you're still here. Appreciate you being here. I've got a couple more minutes before my next call. I'm happy to do Q&A on anything, but this is what we got. Michael, I appreciate you being here, man. Check on our AR processes. Yeah, man. When we got really serious about our AR and started seeing like, man, we have like these failed payments. What's going on? And we got a system in place. Holy cow, that was so much lighter. And at one point for our own business, when I tallied up the cost of us not having our AR system in place, our collections system in place, it had been like $60,000 that had walked out the door, which was painful for business early on. That was not fun. Michael, Brian, Tree, Melissa, anyone, any questions as we wrap today? If not, I hope this was useful to look at some examples of people who were just trying their best. And in all of these cases, none of these owners were like deeply negligent, right? They're just trying their best. There's just stuff that slips through the cracks as owners. And it's like, well, good reminder to just keep up on stuff. Sweet. All right, y'all. That's it for today. Thank you so much for coming to our workshop. Drop us a line. If you got questions, you can hit me up personally, alex@ceofinanceacademy.com via email, or hit that link. We'll drop the link below in the recording as well. So you can book with us if you want to have a jam sesh to see where you're at and what you need to focus on. So y'all, thank you so much. Catch you on the next one. Bye, crew.